Hi guys, thanks for tuning in to another episode of Nuggets News. Well, today we're going to go over a few of the charts and tie together what's going on in the macro world with bonds and currencies, with what's going on in the crypto market and what may lay ahead. Now guys, I know I haven't been able to do as many videos as I would have hoped. I'm still planning on getting back into that and doing more content as I get more time and as my own health recovers fully and all that sort of thing. For the time being, I have been just concentrating on trying to get out one good research piece a week at least for the Nuggets crypto community. The link to that is down below if you want to join. I'll send you a message, and just make sure you check your inbox and your message requests. It might go into the requests when you click to join with the details on how to join, but I'll touch on a few of the sectors that I'm most bullish on within the crypto market and that sort of thing going forward for the next bull market. But yeah, as always, my portfolio and more detailed updates are in that premium group. So the last time I did a video, we were speaking about how we think Bitcoin had bottomed and this capitulation, and it wasn't necessarily just going to keep on rallying and back into the bull market. We know from throughout history and previous bear markets that when we have that capitulation and we bottom, we tend to get that sideways action. Things coil up and then another big move comes. Now, if we have a look at the big picture charts, we've had that 78.6 fib retracement nicely there on Bitcoin, but Ethereum's, I guess, technically got a little bit of a better setup to follow, particularly when we zoom into the lower time frames here. And this is really nice what we want to see in terms of if this is the capitulation bottom, which I'm still leaning towards. We want to see buyers come in when we get that, that 61.8% retracement into the golden zone. Every time we've wicked below that, we've seen plenty of buying. So yeah, things are tightening up. I'm going to talk about the scenarios and I guess a few of the black swans on what could cause us to really capitulate in all stock markets and bond markets and crypto markets and make new lows versus what I think is more likely to happen in the coming weeks and the bull market resuming into next year and the halving hype that will come for Bitcoin and all that sort of thing that we know these cycles tend to follow. So if we have a look at the US stock market, it had a pretty strong finish to this week, which was good to see. And I've been talking about how I think the Fed and central banks are talking up this big game in terms of being really aggressive with these interest rate hikes. And I think we've got to the point now where markets are starting to break, in particular bond markets. And they're the most important markets of the world, trillions of dollars, very liquid, very smart traders. We've already seen when the cracks start to appear there, it can affect the hedge funds and people's retirement, and the banks have got to hold these bonds as their safest source of collateral. So it just affects everything when central banks go too hard, too fast, and we know this has been the most rapid increase in interest rates in history. So things are starting to break, and we're going to talk about what that means as well. So these risky assets, whether it's crypto or stocks, it's all a spectrum of risk. And so money comes out of these. A lot of people have made huge profits. If you think about how markets have rallied so strongly in recent years and even since the COVID crash year, and people that have made money when there's uncertainty around, they want to go into that more certain asset. And for the time being, the US dollar is still the world reserve currency. And as they're raising interest rates, people can sit in what they deem to be the safest currency, while all of a sudden they're now getting 3-4% yield on sitting their money in the bank or the government bonds or whatever it is in US dollars. And so that's a lot better than losing money in risk assets. If you've positioned yourself well and you've timed the market, you're still getting that yield on your US dollars, even though they might be printing trillions of those. You've got to remember, it's all still relative to the trillions of euros that are being printed, or a smaller currency like the Aussie dollar where hundreds of billions get printed and everything gets diluted. It's all still the cleanest dirty shirt in the laundry, for, as I like to say, which is the US dollar. So if we just zoom in a little bit here, since we put in the top, and this was a really, really parabolic, almost blow-off move. So if we I do think that we've either put in a top, or we might have one more little gasp and scare if markets get extremely close to crashing and more pension funds start to talk about, hey, we're going to go under. But we're already seeing central banks having to step in. Just today we saw billions being sent to the Swiss central bank from the Fed, and we've already seen the UK central bank have to step in and print 55 billion, I think it was, in that first day to save those pension funds and start buying bonds. So those cracks that are being starting to appear, their central banks are aware of them, even if they want to continue to talk this tough game that we're going to keep raising rates and we don't care if we break things. It's the price we have to pay to get inflation under control. I think they still want the market to think that's going to happen, but the market's starting to call their bluff. And I know futures markets is still pricing in that we're going to get plenty more rate hikes, and rates are going to end up 200 basis points higher, and that's going to affect the mortgage rates and everything going forward. But anytime we see these sort of retraces, and again, you get to this key area, the golden zone we talk about, and there's plenty of people that are coming in and selling these wicks. So technically it's starting to look like I think we have put in that top for now, and it's the game of chicken. Who's going to bluff who in global markets? So this is the US 10-year government bond. We can see how quickly that sells off. And remember, these things aren't meant to be volatile. They're meant to be the pristine collateral. And seeing the volatility on these assets that are deemed the safest in the world being more volatile than Bitcoin, you can start to understand why these central banks that have the fractional reserve and leverage up, have all their different asset classes, and as long as they've got that safe collateral, they can go into the markets and gamble how they want. But when your collateral starts to fall by this much, and this is meant to be the safest collateral, well, what else are you meant to do? And that's where these central banks are coming in and lending them more money, or either printing money to buy these bonds, put the price up and try and cap those yields and bring those yields back down. Remember, there's that inverse relationship there as we have a look at the yield on the 10-year government bond. And I also think you're going to see, the higher you go, you're going to see more and more buying. Let's say the Fed continued to hike these rates, and all of a sudden you can get, if we get, let's say we get up to 5%, 5.5%, 6%. That's a pretty good deal for these huge players that have made a lot of money. They're on the sidelines. All of a sudden you can lock in a compounded 6% rate, 5%, whatever it is. That's a lot of money in this current environment that we're living in, and the government are on the hook for that. So they don't necessarily want to be paying that yield for long periods of time. Remember, they're only paying, 30, 40 basis points on these 10-year government bonds in the US. Very, very little yield. Another thing I want to talk about is the knock-on effects. So we've seen it probably more so in the US. In Australia, we have a lot more people that are fixed, whereas in the US it tends to be these more variable rates, and starts to impact homeowners more quickly. So they're now at the highest level since 2002, 20 years. And when people have got to all of a sudden go from whatever it is, 1% and 2% up to their 7%, and their repayments have gone up hundreds of dollars a week, a month, whatever it is. Remember, all that money's got to come from somewhere, and it ends up being $100, $200 less a month you're spending on groceries or going out, and these activities of daily living, the things that keep the economy going. More and more money is just being redirected back into the financial system to prop it up. And so the Fed are aware of all this stuff, and we're starting to see a lot of these metrics that are rolling over. And so I think the longer they do this and the harder they push, it's going to be very hard to get that economy back and flowing smoothly once you start to see unemployment rates tick up and business owners laying off staff. Think about how some of the power bills we've seen coming out of the UK, fivefold increases. The cafes are now paying $20,000 a month in these electricity costs, energy costs to keep running their business. So all these flow-on effects that we're seeing at the moment from what's going on in the global economy, they're all the sort of things that are going to really put the brakes on very, very hard. And I think we're going to start to see the economy roll over. That's when central banks are going to ease. The money printing has already begun again when you see these rescue packages that are coming to help the hedge funds or central banks that are in trouble. That's already the first signs that the money printers are being turned back on. If we have a look at the oil market, we know there's a lot going on at the moment. with Russia, natural gas, oil, OPEC, and some of the deals that they've just made to, again, reduce production to try and keep these energy prices higher. That crushes the West, Europe, these other places that are dependent on cheap oil. So they want to try and play their hands, and the longer they can keep oil prices higher, they make more money and revenue, props up their local currency if this is one of their main exports. It's all just this big game that hopefully I've explained to you clearly plenty of times over the years, and you can tie these things together. Now remember, oil crashed to minus $40 a barrel when no one wanted to store it at that time, so you're actually being paid, and that's only back in 2020 when we had that crash during COVID. And since then, we've rallied sharply back up over $120. It's come off a little bit, and that's where OPEC is starting to talk about what they're trying to do to keep oil prices higher. But if we do go into a recession, we'd expect natural gas, or more so oil, but natural gas, very interesting what's going on in Russia. We're going to talk about that in a second. If you've been following the world news, what's going on with the Nord Stream pipelines, and how they've been, sabotaged there, and whose interests does that favour and who does that hurt with everything that's going on. But before that, I want to talk about the UK, where we've seen a new change of leadership. Liz Truss stepping down after only being in power for a few weeks. And so one of the things she wanted to do was go out and do a lot of government spending, and that didn't get passed. And this is where the UK government bonds have taken a huge hit. So once again, meant to be the safest form of collateral for their pension funds and everything. You go from the start of the year, these have lost nearly 30% of their value. Now we're in that sort of capitulation phase. A lot of these technicals are oversold outside the Bollinger Band. So that, again, this is the big picture tying everything together that makes me think that it is likely that the US dollar may have put in that top. This is the Great British Pound, the currency getting smashed as well. Since the start of the year, what have we lost? 25%. But again, really capitulating there. A big wick and some buying coming in, oversold on all those technicals. You can have a look at a similar thing in Australia, where the Aussie bonds have been hit, and the currency sliding as well. And the other thing to mention here is a lot of these markets, like Australia, are reliant on overseas funding. And when central banks have been so bad at forecasting what they're going to do, and as I talk about, a lot of this jawboning where they say they're going to do one thing, we're not going to raise rates for years. Next thing you know, they're raising rates at the fastest pace in history. That destroys the confidence of these overseas other central banks or pension funds, big corporates or whatever it is, to invest in Australian markets, or pick whatever country you want. So all these things are just this big recipe of ingredients on why the US dollar looks safer compared to everywhere else. Even though the US Fed haven't done a particularly better job of forecasting what they're going to do, with all the uncertainty, you'd still rather be in US dollars. This is the US strategic oil reserve. So as the cost of living and inflation has continued to trend higher, once again, people are having to spend more money on mortgage payments, food, oil. These are just all these things that are going to slow down the economy dramatically. And the US midterms coming up, we've seen some of these leaked emails or whatever, or we've seen the press conferences where Biden's gone over and then tried to get these deals going with the OPEC nations to try and get more oil so it's cheaper, to make the economy look better. But at the moment, they're drawing really, really heavily on their strategic oil reserves. So if they continue to do this in the next few weeks and into the midterm elections to try and cushion the price of oil and keep it a little bit more affordable for average US citizen, they're going to run out of these oil reserves, and then obviously they're completely at the whim of importing from these other countries, which they're not getting along that well with for the first time in many years. And this is very similar to the situation between Europe and Russia, where they're so reliant on natural gas for heating, particularly as we head into winter. But all of a sudden, with the global tensions and the media making everything black and white, and who's the bad guy and who's the good guy, and even though you might be reliant on these guys for your energy, you've got to do the team thing and freeze this winter, because we don't like what Russia's doing, even though is that going to hurt your people more than the sanctions that you're imposing on that country? And this is where it's a far more nuanced conversation than what we're always told in the media. And we hopefully by now the mainstream media always tries to play on your emotions and make things black and white rather than seek to tell both sides of the story. And often it's far more complicated than what we've been told. So two things that I see that can cause stock markets to really crash, and I know some of you are in the camp that this is all part of the great economic reset, the World Economic Forum, World Health Organization, deliberately really crashing everything so you'll own nothing and be happy, that Agenda 2030. I want to talk about all those things more in future videos and whatnot. But if they do continue to raise interest rates when things are crashing and cracks are appearing in these big markets, I think that's when we're really going to have to talk about that being their playbook and being a reality, that they really want to tip us into a nasty recession and depression and really wipe everyone out. Employment's going to be through the roof, but the social unrest that is going to come if that happens, I'm not sure if that's going to be politically tolerable. So that's the reason why I'm still not thinking that that's the most likely outcome at that stage. But maybe I'm trying to stay positive and that's my own personal bias, but that's just the way I'm thinking for now, is that they want to push things as hard as they can. It's the same with this political situation here. All of a sudden we're hearing about nuclear war. Now, if anything like that happens, obviously that's a black swan and all bets are off. If the world goes to World War III and we have a nuclear war, then things are going to get pretty bad. But again, is that maybe the excuse they need to say, hey, we've got to print more money, fund all these weapons, and the next phase of getting things going in and rebuilding. So they're the only couple of things, the unlikely scenarios that I see that can really crash markets, and obviously crypto would be dragged down with all of that as well. I still think the most likely outcome is that we're very, very close to the pause or the pivot that no one's a lot of people were talking about a few months ago. Now people are starting to say, and markets are pricing in, well, that's not likely just yet. We've got a few more months of hikes coming, but remember, markets are forward looking. I spoke a lot about the sentiment in the group, in posts and in previous videos, about how the fear of inflation and all that sentiment was the thing that indeed we had to worry about to look for when markets are going to bottom. One other thing I just wanted to mention, this is a fantastic documentary I watched last night. Everything that's going on around the world in the past 2 years is relevant to what may happen next. So yeah, this is a great documentary. It's only free for the next week. That's in my Twitter. I can link that down below as well. So regardless on what your thoughts are on COVID and the vaccine and all that, this is fascinating. I'd encourage everyone to watch. In terms of the sectors that I'm most bullish on going forward for the next crypto bull market, at the top of the list, it's probably scaling. I do like NFTs, but in that sector, I'm looking for more the picks and the shovels rather than specific pitches or collections. I think a lot of that market's become saturated, a bit like in 2017 when we had just so many different altcoins, and obviously 99% of those from the 2017 bull market never recovered or made new highs or so on. So we're starting to see these things that I've been talking about for years play out. Optimism, Arbitrum, ZK Sync. There's another hidden gem that I shared with the group recently. It's these layer 2s and the scaling solutions. They're going to become part and parcel of everyday use to help these layer 1 scale. So when you've got Binance and all the big players, Coinbase, they're integrating these scaling solutions. So you're not going to have high fees in the next bull market with most of these transactions between wallets, between exchanges and so on. Uniswap, a lot of these guys are looking to integrate and rolling out these zero knowledge proof solutions and roll-ups, and this is fantastic to see. It allows for the onboarding of more users without everything getting congested and those sky-high fees that we saw last time around. So if you want more details again on anything I've discussed, and you do want to check out my portfolio and check out the macro updates, some of these write-ups that I've been doing every week, ENS is another thing that I've been pretty bullish on, and a few people have shared their different ideas there. That's for the premium members, but otherwise, guys, as I said, I will look to start to create more content again moving forward. Hopefully that's been an enjoyable little big picture update of everything that's going on. But yeah, I'm still in the camp that we've probably seen the worst of things, or it's very close, and it's been a great time to be accumulating ever since we had these capitulation lows. And if we do get that other sell-off, sure, I think that'd be an absolute gift to buy at any lower than we got last time around. But it feels to me, and the sentiment on Twitter and whatnot, is still a lot of people are waiting for these lower prices to come. And when everyone's still sort of fearful and waiting for that one more low, it doesn't tend to come. So that's it for today, guys. Smash that like button, subscribe if you haven't already, share these videos around, and I'll talk to you again soon. Cheers.